Hi, everyone. This is Jason Burek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He has probably the best free Twitter for charts and graphs. He puts out amazing work almost daily, sometimes more than one a day for charts and graphs with the stock market, commodities, and elsewhere. A must follow on Twitter, in my opinion. He is a portfolio manager, a hedge fund manager at Crescott Capital, which had two of the best performing hedge funds in 2018. Tavi Costa, thank you for joining me again.
Jason, thanks for having me again. Always a pleasure talking to you. I enjoy your content as well. So thanks for having me.
No problem. I always love your insights, and your charts are just amazing. You put out an interesting chart recently about the stock market and the Fed's official balance sheet. We're recording this interview on Friday, April 17th. The Fed's official balance sheet numbers just came out. It's 6.37 trillion now. Just nuts how much the official balance sheet has grown in the last 2 or so months. And it looks like we're having a bear market rally in stocks, but we have the mainstream financial media repeating daily now that the bear market in stocks is over. So do you think that the bear market in stocks is over?
No, I don't. I think it's going to be really hard. I think we're in a phase now that economic activity is going to continue to deteriorate. I mean, we've been seeing macro indicators deteriorating all year in 2019 and 2020. The bubble sort of burst with the coronavirus. I think it's very hard to see. I mean, when in history we had equity markets really bottom at 15% from record valuations, and still when you look at consumer confidence more in depth, at any way you look at it, it's not at its peak, but it's also not at its bottom. So it's still relatively high. I think there's a lot going on in terms of even the unemployment rate, in terms of labor markets, and we've been seeing some cracks in the labor markets since 2019, and now it's been I guess getting a lot worse recently. And if you look at the year-over-year change of U3 unemployment rate now is somewhere close to 16%. And every time we reach that level, we had a recession follow or coincide. And the average recession usually lasts for about 12 months. And that's looking at a 70-year history. I can go on and on with other charts that look the same way, but this one is specifically is interesting because the imbalances that we have today in terms of valuations, debt, and some other issues are much worse than any other recession we've had in throughout history. And what's interesting as well is what's going on with the balance sheet. I mean, I think a lot of people talk about this unlimited version of the Federal Reserve here of printing as much as they want. Personally, I don't think that's unlimited. I think that they can print a lot of money, and that's why we own gold, and why we believe the precious metals industry will do well. But what's interesting is that if you calculate it, since the March lows, we've been doing somewhere close to 75 billion of money printing a day. Per trading day, right? So that's, wow. I mean, yeah, it is. So on a percentage basis, if you just look at the Federal Reserve balance sheet right now, it's growing at a faster pace than actual stocks, which
it's a hockey stick.
Yeah, and I think that's all interesting. And it's hard to look back in history and find other issues or other similarities of interventions that we had in the past, but one of them would be Japan, right? Japan has today, I think their monetary base is somewhere close to, or BOJ's assets are close to 108, 110% of Japanese market cap, equity market cap. And what you see there is that since we've had, I think they reached today in the US, we're close to 20%, right? So the Federal Reserve assets represents 20% of the total market cap in the U.S. here of equities. And when you look at that proportion and you compare with Japan, Japan was somewhere close to 20% back in, I believe was in August of 07. And if you look at the performance of the equity market, it was up about 17% since then, which is not it's a very, very bad performance. At the same time, you had gold in Japanese yen terms going up about 130%. So, this is where I think the game is. I think gold is the only game in town personally. I think this is not going to continue to prop up equity markets much longer. I think we're going to see a problem that's only going to get worse in terms of the macro indicators here going forward. And what is my hedge? My hedge is that commodities will outperform equity markets going forward. My preferred form of commodity would be precious metals. I've been dipping my toes as well in other ones too, but We can go on and on there, but I think there's a lot of issues, and just going on, one thing that I think is critical is a question that I've been asking people is, who is going to bail out whom? It's not like corporations have been doing great. I mean, they have no earnings, so consumption in terms of households is also plunging, and so you have no tax revenues whatsoever. At the same time as you have fiscal spending surging and economic activity is plunging. How do you calculate deficits? Well, you look at deficits relative to GDP. That's exploding now. It's another reason to own gold. At some point, this is going to become an issue, and I think we're already seeing that in the gold market as it's starting to, it's the one of the V-shaped recovers we've seen since this, even the bottom of the markets. The markets have not done a complete V-shape, but gold has already surpassed the previous high. So it's pretty interesting, and I think it's going to continue to happen.
In terms of the fundamentals of the real U.S. economy, I really haven't found any bullish data points unless you want to count Clorox, the sales that Clorox is getting for cleaning equipment, or Costco or Amazon for online sales. I mean, there's very, very few. The broad economic data, whether it's gasoline demand here in the U.S., that's down 48% over the last year. Consumer spending, I just saw an interview a couple days ago with the chief financial officer for Wells Fargo. He says their data, because they have credit cards and debit cards, that consumer spending is down almost 40%. So and in the Empire Manufacturing Index, a lot of the different things that we look at in the economy to measure economic activity, all these things are down enormously. And yet, like you said, the asset prices with central bank intervention, they're trying to counteract the reality of the real economy and how much worse things are getting with the jobless rates. I could go on and on and on, but it seems the wealth disparity and the valuations, the normal defensive stocks, Tavi, normally in past recessions or depressions, the defensive stocks might be bargains, a place you could hide. You could get these things for way below 20 times earnings. But I'm looking at Clorox stock right now. That stock is still, I think, over 30 times earnings. PE ratio is just above 30, 30.5. And Costco is trading on a forward PE ratio well above 30.
Yeah, it's incredible how the valuation is. I think it's going to start to become a problem. Valuations and stock selection will start to matter here going forward. I mean, earnings were already contracting back in Q4 of 2019, even Q3, depending on the company. I think in Q4 of the Russell 3000, just a broader version of the equity market, was down close to 7% year over year. If you looked at that relative to other things that already came out, now there's more economic data coming out for March. So we can kind of see most of the declines have been in between 40 to 60% of declines of either car sales or, PMIs and all things like that. So what I think it's going to happen, and PE ratios are gone. Nobody's paying attention to PE ratios anymore because earnings are over, right? I mean, earnings are going to be plunging significantly, so PE ratios are going to be rising significantly too. And the bulls are not going to be talking about that anymore. Now, pay attention to the private equity industry. Pay attention to the venture capital industry too, because they continue to lead all along. And when you look at that, it hasn't bounced at all. Activity, there's a venture capital barometer on Bloomberg that you can see, and that has not been bouncing like the public markets at all. Number of deals have been plunging, which is just another way to see sort of the true economy. And there's a lot of startups that have been being able to employ a lot of people. I'm not sure if those companies are going to be coming back anytime soon. And the other thing you mentioned about valuations, I mean, there's a long list of companies today, especially in the tech sector, trading at 20, 30 times sales right now. Especially the platform we're using right now is trading at about 60 times sales. So it's, I think that's all kind of interesting. REITs are pretty expensive as well. There's a long list of companies that are still very close to record valuations in any way you look at. We like to combine a lot of fundamental multiples. And when you look at the sort of combined version of those, I mean, we're, at least close to the 90th, 85th percentile. I've never seen markets bottom at those levels. I think this is, when you look at the data is showing us that we're at a very, very deep recession, okay? Now, the valuation part of it is showing it's something completely different. I'm not sure if that's sustainable. And I think it's interesting that there's a lot of people that are proponents of owning gold, owning Bitcoin and other things. And at the same time, I'm not sure why they have so much reliance on central banks. when the central banks actually have a good track record preventing the economy from falling and preventing business cycles from turning? I'll answer that. Never. They have a terrible track record. And I'm not understanding why there's so many investors that rely so much on that. And I think this is not going to end well. And I think, again, another reason it won't go, but to not be the one chasing for those, 10, 15% returns in equity markets with a other probability of losses that could be massive. We saw what happened with the gap downs that we saw in March and February. I mean, that's brutal. That's the real market. That's what could happen if we start losing control of this. I mean, how many trillions of dollars of asset values have we had so far since the February, since the top of the market? I mean, I calculated at least somewhere close to 50 trillion at the lows of March lows. $50 trillion. Do you know how much money they printed so far? About 3.3 trillion. When you look at global central banks, that's not enough. I have to say that's not enough. I mean, it's enough to get gold going, but it's not enough to get equity markets going.
That's only the official numbers, Tavi, that we know about. I interviewed Danielle DiMartino Booth last week. Not sure if you listened to that interview yet. And she said off balance sheet is where the real fireworks are going for the Federal Reserve, that they have 40 different programs running with basically no transparency. And also they're illegal. So it's a technicality because the Fed is only allowed to own U.S. Treasuries and mortgage-backed securities. So the Fed is financing the U.S. Treasury to hold all of these toxic assets that are declining rapidly in value, like investment-grade corporate bonds that are not going to be investment-grade for much longer. You have junk bonds, junk bond ETFs, municipal bonds, leveraged loans, collateralized loan obligations, on and on and on.
Yeah, it's stunning, and I think it's a great point on that. And also, just going back to the valuation of assets. I mean, right now, if you look at U.S. market cap, total market cap relative to GDP, one of, I guess he uses GNP. Some people might troll me on that one, but that's Warren Buffett's favorite ratio to look at the market's valuations relative to the economy. And when you look at that ratio, I mean, we're still at the peak levels of the housing bubble. Or you want another one? Look at the S&P relative to gold. It's at the peak levels of 1929. I mean, how many of those you need to prove to someone that we are near record valuations and this is not a time to be taking risk? I mean, I think it seems to be obvious on the macro data that the economy is probably not going to have a V-shaped recovery as Wall Street thinks it will. When you look at, for instance, at the target price for the S&P 500 relative to where it is trading today, that's what it's being priced in. It's essentially we're going to go back to a new highs by the end of the year. So I'm not sure if that's the case personally, and I'm betting strongly that it won't.
Yeah, I think the odds of a V-shaped recovery are very, very low and declining by the day, especially with the rumors and a lot of strong rumors. I'm not sure if you've heard them, but I'm hearing them from all over the place. My business and finance contacts all over the place about a second wave of coronavirus outbreak in China. I've met professional traders online, professional investors now who are gambling on some of these stocks like Boeing and others and restaurant stocks, betting on a bailout. So that's not any fundamental analysis. That's just pure speculation, hoping that they can scalp some quick profits on some type of new bailout that the Trump administration, President Trump, or the Fed will come up with.
Unfortunately, there's most of the guys that are actually coming back and buying this market is a lot of the retail investors and a lot of people that are using their retirement plan funds to buy stocks supposedly at the lows. And then, I don't think this is going to end well, but it's hard. I mean, you talk to your friends, I talk to my friends, they don't want to listen to you. They think this is another dip, another opportunity to just fight the lows and wait until it gets to a new high. There's going to be a moment when that strategy won't work. And I think that's perhaps the case right now. And unfortunately, probably the big dogs, and he just had an interview right now with Charlie Munger out on the Wall Street Journal. Not even Charlie Munger is optimistic here and coming in and buying a lot of companies at supposedly low valuations. He's not coming in. Most of the big dogs are out of the market. Who's coming in is just, unfortunately, it's most of the retail investors in the Federal Reserve. That's what really is coming in the markets today. And I don't think this is going to end well, I have to say.
Yeah, let's just use a quick example of Disney. So Disney, most or all of their theme parks are closed. No one's going to see their great movies with Marvel in the movie theaters right now. They do have Disney Plus, which is getting a lot of new subscribers, but they haven't added a lot of new shows yet that were planned for this year. So there's not a lot of good things going for Disney right now, and yet the stock is rallying. Now, maybe a couple of years from now, in my opinion, after the shares crash more, that would be a bargain because people are going to want to be happy and want to, go see movies or take their kids to a theme park again at some point in a couple of years. But now's not the time to own that stock. It's the time to be patient and wait.
Yeah, and it's when you look at the list of likely bailouts that we're going to see in terms of industries, I mean it's a long list. I mean it's auto retailers, it's hotels, it's casinos. A list goes on and on and on. Every single company needs someone to hold their hands. And in terms of the consumer, I mean consumer is changing. The behavior is changing significantly right now. Everyone is in saving mode. I'm not sure if that's going to shift back to spending mode as we were a few months ago, as most people think it will. As the lack of consumption is going to start causing issues in the labor markets very clearly, and it already is, right? And I don't think that's going to go back anytime soon. A company that fires someone needs to get back to their own business first. In other words, they need to get their profits back in the game first before they can even think about hiring somebody again. I think balance sheets are going to matter. I think the profits are going to matter going forward. I'm not sure a lot of those firms have, we just reached peak margins very recently. That's not usually when you have that type of mean reversion type of move. That takes a while for things to really materialize. It's not very quickly. It's not a 1 month thing like most people are thinking here. It's not going to be a straight line. We all know that. There's going to be bear market rallies. There are going to be lags, 1, 2, 3 lags. But I don't think this is a time to be taking a lot of risk. I think it's time to be cautious and be looking for things that are actually cheap. Buy things that are at the lows, not things that are still 15, 10% from record valuations. I think that's the point here.
Yeah, the QQQ, I don't know if you look at chart patterns, but it looks like a head and shoulders is starting to form. So we have one shoulder and it looks like the head's starting to form. So that's a very volatile reversal. It's a very volatile chart pattern with a reversal there. So that would be a bull trap. So people who think that the stock market rally, that the bear market is over, if it is a head and shoulders pattern, they're going to get whipsawed.
Oh, I love, you asked me if I like looking at charts. I love looking at charts. I think charts are very important to put the narrative together. You look at macro, you look at fundamentals, but then you just look at charts to see the momentum. I think you're absolutely right by looking at that. I saw some sort of issues back in January before this whole thing started happening with AMD. That was one of the leading stocks at the time. It was massive great doge on a weekly basis candle. So did as well the Nasdaq on a quarterly basis too. It was pretty scary candle at the time, and end up being that that was the peak. I think you're absolutely right of combining technicals along in this process of understanding what's going on here. There are other issues as well. I mean, in terms of technicals, gold's looking incredibly bullish. I also have a very bullish view on the dollar, believe it or not. But I think gold and other currencies and the most overvalued currencies in the world today is likely to rally. So that's mathematically how that ratio works in my view. But
before we talk about gold, one more thing here on the U.S. consumer, since we talked about this a lot. I think one of the few fundamental trends that's being accelerated in all this is e-commerce. So the consumer businesses that move away from more bricks and mortars, that can adapt faster and start having online sales better, those are the ones that are going to, I don't know about thrive, but at least do pretty decently and survive all this, depending upon how long this lasts.
Yes, that's true, and the reason why the labor market was also, adding to your thesis, the reason why labor markets are sort of weak more recently is when you look at the bulk of temporary jobs more recently with Uber, Lyft, and some other businesses that provide that sort of job. That you don't have to be working full time, and sometimes a lot of people actually make more money working as an Uber driver and a Lyft driver than working at the full time job. So plenty of people actually started working for Uber and quit their other full time jobs, and they don't have any benefits anymore. And that's why I think also the labor market problem is a little more severe this time given that the percentage of temporary jobs versus full-time jobs has increased significantly in the last few months, especially with that sort of shift that we've seen. But anyways, I think that's all. And I'm not sure if you're noticing that, but grocery stores, I mean, things are getting expensive. They're not cheap. At least my cart is getting a lot more expensive than it used to be. I think I used to spend, I'm probably going to spending, at least 30% more, 40% more in terms of money. So it's pretty interesting.
How many years has that increased to 30% or 40% more? In a couple years or 5 years? How long?
Oh gosh. So I buy the same things, right? So I've probably been buying a little bit more. So I'm actually adjusting for that in my mind. This is not I haven't been specifically quantifying this in my anywhere, but I know how much I spend on a weekly basis when I go to the grocery store. Ian, you probably do too. Yeah. I'm noticing that right now I'm spending, every time I go there, I'm spending at least $200, $300. And I'm like, well, this is not, it used to be like that for me, at least. Yep. Sure, I don't go to restaurants anymore, obviously, because everything's closed. But so I have that I'm saving. But I'm just thinking more for the average Joe, right? I mean, if you lost your job and grocery stores, grocery shopping is becoming a lot more expensive, and that's your cost of living right there, right? So a lot of people are living in that reality. So I'm not, I don't know. I don't know how long this can be sustainable, to be honest, until things get a little worse. And usually, this type of damage in terms of the macro scenario today, I think that usually takes a little longer to play out. So there's a lot of people betting that it won't. I'm not sure. There's not much history that they can bet on. Or rely on saying that this is going to come back as fast as other parts in time. That's truly a stupid reliance on the central banks that I'm not sure it's going to pay off.
Yeah, the government inflation data, the CPI, is nowhere near the economic reality that I see. I graduated college a little over 10 years ago, and I remember going to Target or Walmart on like a college shopping run and filling up my cart for $75. So yeah, so it was well under 100. Sometimes it was 60. It was between like 60 and 75, $80. Almost never 100. No matter what I bought, the cart was filled. And now it's way over $100, and it's less goods and services. And the government economic data, the inflation data, doesn't reflect any of this. So this is shrinkflation. This is stagflation. This is the widening disparity between the government economic data, what the government says the inflation rate is, versus the reality of people's bills, like you said.
Yeah, and then at the end of it all, then you start thinking about the pillars of the economy, the pension funds, and so forth. I mean, that's another problem, right? I mean, that's another issue that we're seeing more recently with this decline in equity markets and decline in asset values in general. I mean, private equity firms, pension funds are highly invested in those private equity deals. I mean, this is a big deal. Believe it or not, a lot of pension funds have their money invested in those private equity funds. And the impact of that is going to be somewhat severe in my view as well in terms of that. I mean, my wife is a teacher. I mean, I'm not expecting any money back from her pension funds, to have to say. So I've looked at it before, and the unfunded liabilities is just insane. There's no way they're going to pay that unless we're going to be printing a lot more money to pay, to cover, government pension funds. So it's going to be interesting. I don't know. This is a little bit long down the road, honestly, but more, for the next year or so, I highly doubt we're going to see the economy coming back as strong as a lot of people think.
Yeah, I think the pension funds are a mess. They've been the suckers at the table for so long. I just saw a news story this week. Not sure if you saw that CalPERS went unhedged. So they had that enormous stock market rally in 2019. Well, they took off all their stock market hedges in January as the stock market was still rising. They had no protection from the crash.
Oh my gosh. How sad is that, huh?
Honestly, with all the interviews and news stories, Real Vision TV's covering this extensively, all the things I've heard about pension fund money managers and corruption there and lack of research and due diligence from some of these pension fund investment advisory boards and pension fund managers, I'm not surprised.
Yeah, I mean, and even I'm telling you, because this is something we deal with here in my house. I mean, my wife is trying to, we're trying to passed a regulation to use 401k plans rather than pension funds in her school, and none of the teachers want to do that. But when you talk to teachers, well, most of them hate Wall Street in the first place. Who do you think is managing those pension funds in the first place? Just people don't think about that. It's stunning to me. But anyways, it's sad. It's not going to end well in terms of that. And it's not just being pessimistic in general. It's being realistic. Come on. I mean, there's no way people are going to get their pension funds back. I mean, it's just, it's just math. You just look at the numbers. There's no way. But I wish we could do something about it. I'm trying to do something about it with my wife, right? I mean, how can we, try to save up money in a different way so she doesn't, she's not expecting that pension amount at all. I mean, but there's a lot of people in the same boat, and unfortunately, a lot of them, some of them only have, a much worse scenario in terms of the salary. So it's sad, that speaks the truth of a lot of Americans, and it's very sad, unfortunately. And that's, we're including here, considering things are going to be deflationary for some time. And I'm not sure that's going to be the case with this amount of money printing going forward, to be honest. I think it's being very deflationary. There's no doubt. I mean, some people are saying, well, gold should be, well, when you have margin calls and the whole market declining, plunging, it's being net, and that has been more of a deflationary crash. There, I don't think there's a doubt about that. I wouldn't argue there.
I think there's tons. Sorry to interrupt you. I think there's tons, and if I could add to your points there's tons and tons of distortions. So
yes.
All these stories I'm seeing with the food supply chain distortions, the gold supply chain distortions. So it's the coronavirus distorting the supply chain, shutting down travel, plus what the central banks are doing too. And all these distortions probably mean unexpected and weird stagflation, shortages of certain goods, no shortages of others for the consumer.
Yeah, and you're talking about more going forward, right? But I agree 100% with that. And I think that one of the main reasons for that is the low cost of capital that has helped a lot of companies to survive, not just in this scenario by losing money every quarter, but also enabling them to provide goods and services at much cheaper costs, or prices that consumers can afford, and that can change. If you're talking in a world now where you got to make money and profitability matters, well, then those guys have to raise the money that they charge for those products and services, and that's obviously something that takes a little long to play out. But I think that's the end of the. That's going to be one of the resolutions at the end of it. At the end of it all. So we're not even talking about the dilution of money, right? The monetary dilution that's happening with the money printing globally. So that's another issue that is obviously aligned with this. So in terms of dilution, there's no doubt. I mean, that is inflationary. At some point, will turn inflationary. It's just so far that look at commodity prices declining. Look, I think that there's one major reason that nobody talks about inflation. That is even a bigger issue than actual money supply. Okay, and that is commodity prices. Commodity prices have done nothing but go lower and lower and lower since '08. It makes sense if you think about that and also inflation. Okay, now if commodity prices turn, which I think it will happen at some point, when commodity prices begin to rise, I think that's when you start seeing more the inflationary forces. Look at all emerging markets, even Venezuela, for instance. I mean, if you look at commodity prices in Venezuelan peso, well, that has been rising significantly, and that's one reason why you have inflation. Even in Brazil back in 2014, 2015, even though oil prices are plunging, because it's a state-owned company in Brazil, Petrobras, well, oil prices are actually rising in Brazil. For Brazilian consumers, they had to pay more on the pumps. So, that's meaningful in terms of generation of inflation in general. You cannot produce goods and services at a cheap cost if commodity prices are rising. That has not been the case for the last decade or so. Matter of fact, that speaks the truth about the growth of China, for instance. If China is the largest buyer of commodities in general in the world today, how did China grow so much when commodities have perhaps one of the worst decades in history? The answer is easy. I mean, they didn't have that growth that everyone thinks they have. So I think that, in order for you to have inflation, you have to have that turn first. That's my view. But
So what do you mean by they didn't have that growth? That all their growth was phony? It was economic central planning. So it was the ghost cities. It was the unnecessary, wasteful infrastructure projects, because they did build a lot. They did consume a lot of copper, iron ore, steel, concrete, coal. So the copper price did, what, 20 years ago, the copper price was 50 cents a pound, and it did get up to over $4 a pound at one point before it crashed. So I think that was
Yes.
one of the few examples of a commodity price just soaring higher.
There's no doubt that build up is happening in China, no doubt. I think you're right about that, and I think that's a fact. That's not an opinion. However, believing in those 6, 7, 8% GDP growth numbers annually that we had since the global financial crisis, I think that's just phony. I have to say. Did they grow? I'm sure they were growing, but I don't think it was at those levels that we're seeing. I mean, even India is a little. I suspect a lot about the numbers there as well. I mean, I look. I grew up in Brazil, and I looked at the numbers in Brazil too. And Brazil, that's if you think the calculations of inflation, and Americans are very judgy about the way we calculate inflation, other economic indicators. Man, think about the emerging markets. I mean, you guys have no idea. Those guys just put the numbers that they want to put in those indicators. Who cares? Nobody's looking at that. So you have to look at the market. It's much better to actually look at asset prices to sort of have a gauge of what real economic growth you've been through. And it's that's not what you see in terms of commodities. I mean, you're talking about 20 years, but look at since the global financial crisis. I put out a chart on this. I put all commodity prices, normalized returns since the global financial crisis. And what you see there is there's only one commodity that actually spiked up, and that's palladium. All the others are down, or actually significantly down. Look at nat gas. Look at oil. Look at iron ore. Look at copper. I mean, all those industrial commodities are actually down significantly. Even gold is not down; it's flat pretty much since then. So, it's stunning to see that, and I think that it has or agricultural commodities. Look at every agricultural commodity. How can you have inflation if agricultural commodities are plunging in prices in the last decade or so? Now, is it going to continue to be that case? Probably not. I don't think it's going to be the case in the next 10 years. Usually, we see some disruptions in supply and some other issues that usually tend to cause the prices to rise. I mean, look at pork prices in China, for instance. I mean, they're still high relative to what they used to be in history. And that usually causes the cost of capital to rise. And there's two ways to cost of capital to rise. Either is to default, right, of companies defaulting, and they have to issue debt at a higher rate, or it's just the inflationary force that causes cost of capital to rise. We haven't had that second one yet in a long time in America. Other countries, we did. Brazil just went through one back in 2014, 15, 16. And now, sort of came back, and now we're having issues again. So,
well, Brazil just did Brazil over the last 4 or 5 years after the taper tantrum 2013, they started an enormous amount of forward dollar swaps off balance sheet for their central bank. There's been articles that have been coming out. There was a whistleblower inside Brazil central bank who went to Bloomberg a number of years ago, I think around the Bolsonaro election, talking about this. And that's why the Federal Reserve issued these 2 press releases for the currency swaps, and Brazil was included in a week span. But are you surprised, Tavi, that the dollar index is so high still? I mean, it's at 99.78, and look at all the liquidity, the emergency liquidity programs, bailouts, off balance sheet stuff, just trillions and trillions. It seems almost every day. I call this another day, another bailout, where the Fed is making an announcement, or Congress is making an announcement for hundreds of billions or $1 trillion or more in commitments.
I think it speaks for the issues we're having with the dollar shortage outside of the U.S. And I think this is starting to become an issue. You can look at the sequence of facts that's happening now. We had close to $3.3 trillion printed by global central banks if you aggregate all of them. It's about 3.3, 3.5 in the last 50 days, right? 70% of that is from the Federal Reserve. I'm not sure if this is being coordinated. I have no idea. Nobody does. All right. This is all conspiracy thoughts. But it's sort of strange that the Federal Reserve is the one really taking the pie here. to another level. And it would make sense in terms of the issues we're seeing with dollar shortage problems. You've been talking about too. I've been talking about as well. A lot of people have been kind of mentioning this before, especially the BIS, been mentioning about $13 trillion or so of a dollar shortage issue that we're seeing in the world today. That's just an estimation, but
it's more than that, because in December, did you read the Bank of International Settlements December global macro update?
I read a lot of those. I'm not sure if I read that specific one, but go ahead.
Yeah, they spent over 24 pages on the forward dollar swaps. So not only is it the normal dollar denominated debt, which you said that's the 12 trillion, 13 trillion margin call because the global economy is not functioning normally. So there's a cash flow problem. So you have all of these entities, Chinese real estate, emerging market companies, emerging market governments that are not earning the dollars that they expected to earn with a normally functioning global economy. But it's also the derivatives. So you have to add the forward dollar swaps on too. And then the margin call is even larger than people think.
Yeah, and there's the asset liability mismatch as well, right? With asset prices declining or plunging, I should say, depending on the place. I mean, if you're in a leveraged financial market, let's say like real estate, you look at fixed assets year-over-year change for China more recently, it's been plunging like never before. I mean, if you're in that business, I mean, you're pretty much out of business in general. I mean, and we haven't even seen that in the U.S. yet. I think that wave is coming here in terms of the impacts of the coronavirus, even on that. There are plenty of ways to look at that kind of calculation of housing market impact, but the real estate market is a huge one. Real estate in Asia was extremely expensive prior to all this. I mean, look at Hong Kong. Even prior to the political issues we had there, things are at unsustainable levels. I mean, even places like Australia, the more Pacific areas, and it's pretty astonishing to see the values are now having issues. So that asset liability mismatch will become a problem too in terms of what you just said. Now, how do you explain the strength of the dollar while we had most of the money printing, or I should say, I can quantify that for the last 50 days, which has been most of the money printing. 70% of that is coming from the Federal Reserve. So how do you explain that this dollar strength? Well, it's just one way to explain. It's the dollar shortage problem. There's no other way around that.
Let's simplify that for some of our listeners who are not financial professionals like you and me. So that this dollar shortage means that they have this dollar denominated debt, dollar bonds, or they have these dollar liabilities, dollar derivatives, and they need dollars to make payments. Maybe they can't pay the whole loan off, the whole dollar denominated debt off at once or over years, but they need those dollars to make payments so they don't default. So it would be like for the regular Joe or Jane on Main Street, if they can't pay their credit card bill, if they miss a payment, or if they miss a payment on their mortgage. And that's what's happening now. That's why the demand for dollars is so strong.
Yeah. So yeah, and at the same time, we have some emerging market currencies already selling off significantly versus the dollar. I mean, the Brazilian real is a good example of some sort of some form of and fashion of disorderly sell-off that we've had so far. And the funny thing is that when you look at the central bank actions, they are not panicking at all. They're okay with this. They've been saying that this is part of the plan. Oh, come on. This is those guys are losing control of their currency. And if things get worse in terms of the dollar shortage issue, I mean, those currencies are just going to plunge. They've been plunging already. So, I think that also speaks for the risk of other currencies like the Chinese renminbi and the Hong Kong dollar and some others. But the Brazilian real is it's just a good gauge of what's going on here. I mean, it's not usual. I mean, the Brazilian central bank has one of the lowest interest rates ever in its history, especially relative to the Federal Reserve rate. So if you look at the differential between the two, is also very low. Who do they think they are? Switzerland or something?
How much is the Brazilian real down against the dollar? Because I've seen the charts of the Mexican peso against the dollar, the devaluation of the peso, and then also the Australian dollar against the dollar. I haven't seen the Brazilian real.
Yeah, so there's different ways to calculate this. So let's look since you want to talk about since the beginning of the year, which it's significant already, 20% decline already since the beginning of the year. If you look all the way back to to August, that's close to 30% already lost in the currency. I mean, this is significant, and it's it probably only going to get worse. But if you look at the currency itself, all the way throughout history, it's the most overvalued, not overvalued, but most the highest appreciation we've ever seen in history of the Brazilian real right now relative to the dollar. So it's starting to catch some it's starting to become disorderly, and I think it's going to get worse. I think it's probably going to get worse because of until the central bank acknowledges the issue and begins to defend the currency. That's not what they're doing at all. Go ahead.
The Fed put in the global repo facility, right? So these other countries, these other central banks would not dump their treasuries for their $4 that they need. So the Fed is acknowledging that there is a problem with the global repo by putting in the global repo facility and the 2 currency swap press releases. Is it enough? Probably not. It's probably not enough, because look where the dollar is, right? Because the Fed doesn't want a strong dollar, neither does President Trump, who tweets about the dollar a lot for the last year or two, Trump administration treasury. So I've called this the dollar tug of war. Not sure if you saw my tug of war video. So that the main people running the U.S. economy, President Trump, Treasury, Fed, they all want the dollar down, but they can't get it down. They want it weaker.
Yeah, you spoke for one of the sequence of facts that is in my list as well. Yeah, the extension of this swap lines to foreign banks. You have also, you probably heard the Jubilee, that Jubilee news of freezing that to of the smaller of servicing of smaller countries now. And why do you think this is all happening? It's kind of because a lot of those guys have to sell foreign reserves to service their debt payments in the first place. So this is becoming a problem. There's not a lot of people paying attention to this, and unfortunately, a lot of the gold bugs are right about the issues that we have in the dollar, and they're right about the economy. But I think they're underlooking the situation and thinking that the dollar is going to just lose control when there's not really a better alternative in terms of fiat currency. What is the better alternative? Go ahead. There's no a better alternative. Is the euro? Is the Japanese yen? Is the Aussie dollar?
I would prefer gold backing and silver backing, like a buy Metallic standard. But the people running the system, I don't think would agree with me or you about that.
Yeah, I mean, the other question as well is in terms of central banks are becoming almost like hedge funds. What they should be doing actually is just buying silver. They could buy the entire silver market today at the levels that it is. Can you imagine that? If they actually do that, that would actually be smart. They would actually make money for once, rather than just print money and let it dilute. But anyways, I think that would be a smarter point. But anyways, it's outside of my actions. So
FDR started buying silver, right? And that caused, I think, hyperinflation in China, if I remember my history correctly, because all that silver in China came to the U.S. because the U.S. government, FDR, was overpaying way above spot price. So China was on a silver standard then, and their silver standard broke because all the silver came here into U.S. government silver stockpiles because they were paying too high a price.
Yeah, I mean, that's the problem, is when precious metals prices begin to rise significantly. That's when things become problematic, and there's a lot of links to what's happening today and what we had back in 08 or so. Especially with things like silver, for instance. I mean, silver. If you look back in late 08, I mean, we've had a very similar type of money printing situation that we had today here. I mean, we had, somewhere close to $1.3 trillion in 2 months back in late 2008. And then silver went parabolic for the next 2 years. Today, we're already printed, $2-something trillion in the last 45 days or so. There's another announcement that they're going to be printing close to $2 trillion. It was 2.3. So I'm including the 300 billion that increased more recently, and saying it's another $2 trillion to go. At the same time, when you look at gold to silver ratio, is one of the highest levels in history. And back then, when silver went parabolic, that ratio was 30% lower. So I think there's I don't have to be right about this, but I'm just talking about probabilities. There's a much higher probability of silver going parabolic than a lot of people think.
Especially if copper miners go bankrupt, and a lot of that silver byproduct from the copper miners that comes offline. And I just interviewed Nolan Watson yesterday. Not sure if you heard that yet, but it sounds like the copper miners are in big, big trouble. And there's going to be a lot of bankruptcies over the next couple months unless copper prices rise. So that would benefit silver.
100%. Yeah. I mean, it's silver is at an incredible setup in terms of buying silver today. I mean, it is one of the few commodities. It has a little bit of the industrial aspect to it, which is not very good if you were looking for a more of a defensive play. But I still think the silver is probably one of the cheapest macro assets in financial markets today, I have to say.
Yes, plus the majority of annual silver supply is from copper and base metal byproducts. So if that supply comes offline, that would be a really good tailwind for silver.
Well, and think about this. There's not a lot of people covering this, but there's, look at money market mutual funds today. It's at the highest level ever. It's somewhere close to $4.4 trillion. It's been spiking up. So people have been selling their mutual funds and buying money market mutual funds. And what you see there is that with $4.4 trillion, right? That's for a lot of people, they're thinking, oh, that's cash in the sidelines. Okay. Think that only 4% of that would buy the entire precious metals industry in Canada and the US. Think about that for a second. I mean, this is truly cheap. I mean, this is the one industry that I can think of that actually benefits from all this, monetary experiment that we're seeing more recently. And it's still an industry. Name one industry that benefits from that also trades at the 1980s levels. That's precious metals industry. I have to say, there's no other industry that benefits from all this that I can think of. And I think that's going to be a big change in markets overall. And when you look at just look at there's only one company in S&P 500 is a miner. That's Newmont. One company. I mean, I think that's going to change a lot. Or you just look at the list of billionaires in the world today, the top 10, for instance, or top 20, there's not a single gold investor there or large gold investor. So I think that's also going to change significantly in a few years. I think we're going to have a ton of others joining the party there. And one of them is probably going to be Eric Sprott. I have to say, there's one person who's fully invested in this industry is Eric Sprott, and he's smart. I think he's going to kill it.
Yeah, I had the pleasure to meet him in person a couple times when I was flown up to the Sprott headquarters in Toronto to meet a lot of their executives at their company. He's amazing. He's a really nice guy too, very humble for a billionaire. Let's talk about a couple more questions here because I don't want to keep you for over an hour. I want to get your thoughts on the oil market because I don't think I've ever seen what's been happening in the oil market since the first week of January. And it accelerated with what happened in Wuhan and China, and it's just gotten worse and worse and worse. Demand looks like it's a falling knife. I don't see any end in sight yet for the demand side of oil. So what's your view on the oil market?
Yeah, I have a very different view, I would say, than most people that have a pessimistic view on the markets in general. And my issue, it's almost like twofold, is technically speaking about the markets, and it's also geopolitical. I think there's a lot of geopolitical issues that are kind of under the radar, not a lot of people are talking about it. One of them being Iran. I think that Iran was one of the few countries that have been hit really hard, not few countries, one of the countries that have been hit really hard with the coronavirus situation and it's still under severe U.S. sanctions. And I think that's a big problem for them economically. And it's forcing their president, for instance, to kind of seek leadership with other hardliners that are chasing more of perhaps even a costly war with Trump, in my view. So when you look at this, another sequence of facts, right? So last week or so, we had a few missiles being fired on some U.S. oil project in Iraq, number one. And then we had early this week, I believe, there was a Hong Kong tanker that was seized by a group of men and then escorted into the Iranian water. And then third one was Iran sent a Islamic one of their guards to sort of harass U.S. Navy ships as well more recently. So I think their goal seems to be clear. They're trying to escalate their problems with the U.S. and push Trump perhaps into war. What I also see in terms of the market itself, so that's not, I don't disagree with the demand side. I don't disagree with the oversupply. I think that's all. The real question is this somewhat priced in, and what's my risk reward of buying oil today? When you look at the year-to-date performance of oil, it is its worst performance ever. It had its worst quarter ever, and when you look at that chart, it's just stunning. Like we've never seen any performance like this in oil before. When you look at the forward curve in terms of the contango that we've reached, that's at record levels as well. It marked every major bottom we had in oil too. When you look at oil relative to the S&P 500, for instance, it's another, just a historic double bottom. It's, and I think we had that in a little bit before the tech bubble. Oil went up 240% in the next 22 months or so. So that's another issue. When you look at oil versus this 200-day moving average, it's also at an extreme, and it's actually at the lows of the global financial crisis. Let's mention another one. Very recently, we had the energy high-yield spreads reaching a record level. That is actually moving lower already. So it's sort of moving or leading the oil market in general. And then when I look at oil service stocks, for instance, they're trading at what? 0.35 times annual sales. I mean, and then when I look at the S&P 500 energy weight is at 2.6%, lowest level ever. I mean, someone has to start taking a position here. It's not a major position for us. For instance, today, it's, some of the stocks are up. It's helping us. The oil itself was down a little bit this morning, depending on the contract that you own. So the front month actually is down 9%, but the other months is not down as much. So it depends on the way you look at. We're actually up today because of the energy stocks. When you look at energy stocks since the March lows, they outperformed the market in general. My point is, look, I have a bearish position in the markets. We have a bearish position. Net short the market today. I have to look for, we're a hedge fund. We're looking for a smart hedge here. And our core position is to be long commodities and short equities because that ratio is at a 50-year low. Most of those long commodities are in the precious metal side, and we're starting to see some asymmetry type of returns in the oil market. And if we use our models, we're able to find companies that trade at really low valuations that actually make money in the oil industry, believe it or not. There's plenty of companies that don't make any money. I don't doubt that. There's going to be plenty of bankruptcies and so forth. But it's almost like the gold industry. If you're selective, there are some good companies out there. It's a moment to be selective and look for opportunities. There's a lot of opportunities in the oil market today. Look at Sam Zell. Sam Zell's joining the party. He's buying oil too. Extremely smart guy, and he's patient as well. I think we're being patient. We just, can I lose 50% in the next month or so? Yes. But I think my upside is much higher than that. So, I'm excited about it. I just think that if I'm wrong about the equity markets and equity markets go take a new highs, well, what do you think is going to happen with oil? If demand is going to come back and people are going to be spending money again, and I'm completely wrong about all that I said here, well, what do you think is going to happen with oil? So that's, it's sort of that trade versus equities that I think it's a lot more attractive. It has nothing to do with my views. China is one of the largest buyers of oil. I don't have a very positive view on China. I don't think the demand's going to come back from China's side at all. It's just a point of where we are in terms of geopolitics, number one. And number two is where oil markets in general are trading in terms of the all this technicalities of the oil market. And I think that's starting to look as an interesting setup to be starting to buy some of oil. So we're doing that more recently.
Yeah, oil has to rise at some point. I don't know if it's a month, 2 months, 4 months, 6 months, a year. It has to go up because the suppliers are not going to make any money. And then everyone's going to lose money. No one's going to be able to afford their CapEx bills. It's going to be a total mess. There will be bankruptcies. I still think it's going lower, at least for another month or two, probably longer than that. But Sam Zell, he's very shrewd, Sam Zell. He got out of the real estate market before it crashed, before 2008. So he sold, I think, all of his real estate, went to cash. So he saw that real estate bubble was going to burst before 2008. And then he was buying gold. I think early 2019, he disclosed on a Bloomberg interview, he was buying a lot of physical gold and gold mining stocks. And he said he had never bought those before in his life.
Yeah. And, it's to your point, you're absolutely right. We're going to see bankruptcies, more widings and so forth. But that's all positive for oil. What am I missing here? It's all positive for oil itself.
Yeah.
So
as long as you don't use leverage, so no margin. If you're patient, yes. But the hedge fund managers that were trying to do this contango trade with futures contracts, right, on margin, the ones who are guessing that the oil bottom was in, those are the ones who are getting killed with the margin calls, who are using too much leverage.
Yeah. So yeah, and if are we going to see days in which equity markets go down and I'm sorry, the equity markets go up and oil goes down? Sure. Perhaps today is an example. But that doesn't happen very often. Okay. Most times, if the equity markets go up, oil goes up too. And I just think that oil is going to go 3x versus the market. And I think that my downturn here is not as severe as the potential for the upside. So it's almost like a pair trade. Okay, so don't judge me for the oil, judge me for the performance of oil relative to S&P. I think that that's a better way to see it. It's exactly the way I see gold. For instance, today we're seeing a very different dynamic, which is oil or gold stocks. At least last time I checked, they were down, along with oil, with the equity markets going up. This is not a dynamic we've seen throughout this those last 2-3 months. When the market is up, gold stocks are up much more. I mean, I just said that when you look at the March lows, you thought that the equity markets went up a lot by 20-30%. Well, some gold stocks went up 2x that amount. So, the overall actually GDXJ, which is a terrible way to buy gold, in my view. But if you just use that as a gauge as well, I mean, that's up about 40% since the March lows. So, it's just kind of interesting. Actually, oil stocks, most of stocks actually outperformed gold stocks since the March lows. Do you know that? Not a lot of people know that. Not a lot of people know that oil stocks have been outperforming the equity markets tremendously. Some of them, not all of them. And it's, for me, that's kind of interesting. It's another way to look for ways of being up if the market is up as well.
So my last question before I let you go, you've been very generous today with your time for an hour. A lot of great insights there about the oil market, the stock market valuations, the U.S. consumer, Chinese economy, emerging markets. But it seems there's been an enormous amount of rules changes, whether that's leverage with the banks, leverage with the leverage ratios with the banks, the Fed changing the rules and basically doing illegal activities with the Treasury for off-balance sheet special purpose vehicles. There was what went on with the LQD, which is the iShares investment grade corporate bond ETF, how a lot of professional money managers and traders I know had puts on that. I think Raoul Pal disclosed last year that he had an enormous put position on that. And for a while, he made a really good profit on that. And the rules changed and all the shorts on with the Fed buying investment grade corporate bonds. And also I think the EGF too, I think they're buying shares of that. So that the rules got changed and the hedge fund managers got screwed. Do you expect a lot more of this with rules changes? And do you think that shorting will get banned?
I think it's possible to get banned at some point. However, speaks about liquidity. Short sellers provide a lot of liquidity to markets in general. And if you're a long short fund, for instance, and you're not able to short, what do you think you're going to do? You're going to lower your long positions, and that causes issues with the markets in terms of liquidity and in terms of even selling longs. So I think that can be a problem in this sort of more longer period of time. And I think short sellers serve an incredible purpose, and I think that would be very sad if you start seeing that. Now, answering your question in terms of the Fed policies more recently, I think, welcome Trump as the new leader. I mean, Trump is really the guy, perhaps really driving all those policies with the SPVs that you're referring to. I think Jim Bianco is on the front of a lot of that, along with Danielle DiMartino as well. So it's I think that there's that's going to continue at some point where we're going to be seeing more and more is the helicopter money type of policies because of the unfortunately there's a pretty big spread between the wealth spread is just getting worse with those policies that we're seeing today. But you got to understand, I mean, if the Fed wouldn't have stepped in the junk bonds, I think the junk bond would have imploded already. And it was already imploding in a big way. We have some shorts still in LQD, believe it or not. I think that people should not be spooked out by the amount of Fed intervention. I think you got to look at the amount of intervention relative to the size of that market. A good example of that is still Japan. When you look at Japan, A lot of, why is equity markets in Japan haven't been, being a great place to be invested in? Well, there's a reason for that. It's because not all the time monetary intervention helps in terms of what's going on in that market. So I think it's going to be a similar position here in the U.S. I don't think it's going to be Federal Reserve says that it's unlimited in terms of what they can do, but it's not unlimited. If they print $30 trillion by the next month, you're going to see gold getting out of control, and they're going to have another issue, which is a currency problem. They don't want that either, and a currency problem causes a treasury problem. So I think that's the biggest problem. And when you look at the size of the balance sheet, most of the balance sheet right now, about 50% of the balance sheet right now, has been to buy treasury notes and bonds. And so I think that's why is that happening is because the government's broke as well. There's emerging markets having to sell foreign reserves to buy to either pay that or just use dollar in generals. And what's going on is that the Fed has to be, the Fed's going to have to be the buyer of last resort all day going forward here. So, it's going to be tough to exit this whole plan given that situation. Remember, the repo crisis wasn't a problem that started with a lot of people are seeing that as excess of liquidity by the Federal Reserve providing liquidity to the equity markets, and the equity markets should be rallying a lot. But that was the problem of liquidity in the first place, with the government issuing too much debt. What we're seeing with deficits today and the situation already of unsustainable levels of debt, not just in the U.S., but other governments too. This is not just a problem in the U.S. at all. It's getting extreme, and I think the Fed is going to have to be stepping in more and more going forward. That does not mean the equity markets need to move higher. You have to think about what is the amount of losses in asset values that we're seeing, and how much is the Fed stepping in? Are they going to step in to really stop the losses of asset values in general? Like that $50 trillion that I was referring to, are they going to be printing $50 trillion? That would be an excess of liquidity. Right now, with $2-3 trillion, even though it sounds a lot and it's great for gold, that's why we own gold, it's not enough to stop the equity market, I have to say. So I still think this is all a bear market rally. I still think this is all going lower. And I don't think it's a straight line. And I'm going to be wrong a few weeks and right other weeks. And it's going to be part of the game. I hope I'm going to be right. But I think this is not a moment to be buying risk on assets at all, especially at these valuations.
And this is why the government officials want to restart the economy in the next month or so, give or take, because they need those cash flows from normal economic activity. Because like you said, I think it is unsustainable for the Fed's official balance sheet to be a hockey stick like that, because they realize at some point this dollar shortage is going to go away. And then people are going to start to question if the value of the dollar. So if it should not be marked significantly lower with a devaluation, and then at that point, the Fed has to change policy and try to defend the currency instead of try to deal with the dollar shortage globally.
Yes, and if you think about that, if you think about this sort of monetary debasement happening worldwide, which I think is sort of synchronized in a way, you got to think about how can I own gold relative to other extremely overvalued currencies? Let's think about this. If you're long gold in Hong Kong dollar terms, okay, if you're wrong about this, you still long gold in dollar terms because that currency is pegged. So you're just adding an asymmetry to the trade. If the Hong Kong dollar depegs, which is very cheap for you to put that trade on, in if you're a hedge fund, because of the regulations to really get an ISDA agreement and all that. But if you're able to do that, you're just adding another asymmetry possibility of returns here in terms of the lag of the trade. So I think, and if you're wrong about that, if you're completely wrong, you're still long gold versus the dollar, which I think it could go higher. So, it's thinking about gold, but also thinking about owning gold versus the most overvalued currencies in the world today. That's what we call the macro trade of the century, which is being long gold in renminbi terms and being short equity markets. Look at that ratio today. It's spiking in the last few months. And I think it's only the beginning, I have to say. I think it's going to be truly the macro trade of the century. Because when you look back in history, when emerging markets blow up, you see gold prices rally in local currency terms. I think this is going to be the case with China today.
Yeah, I think the next phase of the global gold bull market it's actually started in 2019 because gold was at or near all-time highs in every other currency pretty much except for the dollar. So I think that trend will continue. I think the dollar gold bull market is back. I think there's going to be a lot of volatility. There's going to be a lot of up and down moves, but I think overall the trend is clearly gold prices higher, because the central banks don't really have a choice at this point because there are no normal cash flows from normal economic activity with capital gains taxes on the long side for stocks, bonds, real estate. There's a lot less of those. And then also the normal taxes that were being collected at the state and local levels, that's not happening. People are not going out to restaurants. People are not going out to bars to drink. People are not shopping at bricks and mortar retailers. So all those tax revenues have evaporated. Those tax revenues plugged the hole, so the central banks didn't have to expand their balance sheets at this pace.
Yes, and I just want to point out one last thing that I put out recently, which is, remember the Federal Reserve balance sheet just a few weeks and months ago, actually, I think it was weeks ago, just surpassed the PBOC balance sheet. I put out this chart. Why is this important, right? I mean, this is important because you're seeing that the U.S. is truly taking monetary policy to another level. At the same time, during this period of time when the Fed is doing a lot more than PBOC more recently, okay, you're still seeing the USDCNH at above that 7 handle, that key 7 handle. It has not even gone below that. I think it's another reason why you want to be short the renminbi. I mean, imagine when they really join the party and start printing money as well, which I think they are already. But I'm just saying if they really do, because they're going to have to. I mean, if their economy is grinding into a halt, and I think that's only going to get worse, and that they're going to have to print more money, I think USDC and HCNY will be in a very different level in a year from now.
Tavi, you've given my listeners so much great information over this hour-plus long conversation. I'm actually going to have to re-listen to all this myself to digest it all. So thank you so much for your time. And if my listeners want to check out your hedge fund or follow you on Twitter, and you are a must-follow on Twitter, your charts and graphs are exceptional for free. The level of the chart work is just exceptional. So how did they do so?
Oh, thank you very much. I appreciate that, Jason. So I would say at Tavi Costa would be my Twitter handle, and also we have a website that is very open. There's all the letters, all the things that we report usually are there. So it's crescat.net, www.crescat.net, and you can find all the good stuff there. I would say, especially our letters. Read our letters. I think there's a lot of interesting takes in the markets in general there.
Excellent. Well, thank you again so much for your time, and I look forward to speaking to you again.
Thank you. Pleasure to be here again, Jason. I appreciate it.